Okay. All right. So now what happened? I mentioned earlier. Okay. Next, let's look at the next one. So you're clear about this? So you have to look. This is why we call it is where you have to look at the transaction. You have to recognize what is actually happening. Remember just now the first
I have a question.
we're talking about the accounting cycle, right? You look at the economic activities and then you identify what is actually happening. Right, from there you identify, okay, is an asset, is it a liability, or is it an honest equity, and put that transaction into your reports. Okay.
Doctor.
Yes.
Yeah. Doctor, sorry
Doctor,
to
I have a
interrupt.
question.
I want to.
Yes.
Okay. Based on the statement itself, for example, if we already know from the balance sheet that the company have cash, but if they stated that it is account payable, the company can choose whether to use the cash, although they have enough sufficient money. And in the balance sheet, we have to follow the statement, right?
No. Even if you have cash, but if the transaction say that it's on account, it means that it's on account.
All right. Okay.
Right? Okay.
Okay, understand.
So you look at the what the transaction, then you just follow the transaction. Okay. Next question.
Prof, I have a question. Yes.
Yes.
So here they say due within 60 days. Does that mean that the 13K has to be paid within 60 days?
Yes, it is.
So from the day of purchase, which is on the
normally the
23rd
60
of
days
January.
is computed from the following day. Then you compute 60 days.
Okay, so within 60 days, the company must pay the accounts payable, right?
Yeah.
And doesn't matter whether it's in cash or online, as long as they pay.
Yeah. What else do you want to pay if not in cash?
Maybe I'm not sure if this is related or not, but can you pay by assets such as like land or building?
That would be an advanced level where instead of you pay by cash, you have to pay. But because if possible, of course, company would not want to trade their asset other than cash, because land is very valuable.
Oh, okay.
Okay, now is that it says that overnight realized that the company had purchased more tools and equipment than it needed. So on January 24th, overnight sold some of the new tools to Ace Towing for 1,800, a price equal to overnight's cost. Ace agreed to pay the amount within 45 days. So what happened here is that, right, remember just now you bought tools and equipment. Now we say that, oh, I have too much tools and equipment. All right, I do not need that. So what I do is that I sell those tools and equipment, and the company sold those equipment to Ace Towing. How much? 1,800. So when you sell to Ace Towing, right, the price equal to overnight cost. So when you sell something at cost, so it means that there's no profit or there's no loss, right? And then Ace agreed to pay the amount within 45 days. So what happened here is that you are going to reduce, all right, because you sell your tools and equipment, means that your tools and equipment will reduce by how much? How much is the
1,008?
1,800. Means that your tools and equipment will reduce by 1,800. So initially it was 13,800. Now it reduced by 1,008. That's why now you have tools and equipment of 12,000. Right? But right now you have accounts receivable. So when you sell, you're going to receive the 1,800 later. Right? Because why you sell on account? So Ace Towing is what we call your accounts receivable, right? You're going to receive from Ace Towing, and he is given a 45 days to settle the $1,800, right? So in here, you see that the changes happen is both in the asset, All right, your tools equipment reduces by 1,008, but account receivable increased by 1,800. So there's no changes in totality of your asset. All right, and there's no changes in your liabilities and honest equity because it does not involve those accounts. But your accounts receivable now, before this, you don't have any account receivable, but now you have your accounts receivable. Yeah. Tools and equipment reduces. So because of that, because you reduce 1,008 and then you increase 1,008, so now it balances back. Yeah, so it set off each other. Is that clear so far?
Okay, Prof. Under the liabilities accounts payable, why they did not deduct the 1,008?
Because 1,008 is not accounts payable. 1,008 is accounts receivable. Because you sell to someone will you pay later. Not you pay. Okay. Okay, for example, Honey, you have
Yeah.
you have a tools and then you want to sell to Hakim.
Okay.
Okay, you will get money from Hakim or you have to pay Hakim.
Of course, Hakim will pay me.
So Hakim will pay you, but you will receive from Hakim.
That's correct. Yes, I will receive from Hakim.
So that's why we call it as a receivable.
It's 9 o'clock.
Because you have to look at from the company's perspective. The company will receive the money 1,800.
Okay.
Yeah.
Okay. So my question was why they did not deduct from the accounts payable, like the 13K, 8, the liability.
Why you want to reduce from accounts payable?
Because there's someone is going. I mean, the customer is going to pay 1,008 from the tools that we have sold. So I mean, in under the accounts payable, we don't touch it. We just put the value as it is.
What do you mean by payable? Mean that the company overnight auto service is the company. All right. So when you say that payable, mean that company has to pay in the future. But when you say that the company is going to receive in the future. So we're talking about 1,800 here. You're talking about the company is going to pay 1,800 or company going to receive 1,800?
Receive, yeah. The company will receive 1,800.
So why you want to involve your accounts payable account?
I'm not sure. I thought that we has to change. So
no.
The question, yeah.
When I say the accounts payable, it's only payable. Accounts payable. When I say it's account receivable, it's only because of you are going to receive it. You are not going to set off each other, right? It's wrong.
Okay. So in this case, can I say that the tools and equipments, the company has not paid for it yet? They just took it, but they haven't made the payment.
Yeah. Estowing took them because you sell to Estowing. Estowing has not paid you. They are going to pay you later. But you cannot say pay you later mean that it's payable because the company is going to pay you, but you as the company is going to receive the money later.
The money, yes, that's correct. Yeah.
Right. So careful with that. Okay.
All right. Okay.
All right. And then what we have here now, you pay Estowing. Who is Estowing just now? Estowing is your accounts receivable or accounts payable? You remember Estowing here?
Account receivable.
Receivable. All right.
Yeah.
So you say that you're going to receive from Estowing, right? So if here you say that Estowing pays overnight 600 as a partial settlement of its accounts receivable. So what happened here, Johan?
So that means the cash is increased 600 and account receivable will reduce 600.
Wow, you're so good, lah. Yeah, that's how you see it. Means that so whenever you have Estowing pays you, that means that your cash increases by 600, your account receivable reduces by 600. Yeah. So that's how you see again, both are assets, but there's an increase in asset, there's also a reduction in the asset, so it's set off. Right? So it means that there's no change in the total asset, there's no change in your liabilities and honest equity, but the movement of the asset accounts. All right, cash increases, but account receivable reduces. All right, so that's how you should see the transaction. What increases and what decreases. Okay, so let's try another one. Let's have Alia. On January 27, Overnight made a partial payment of 6,008 on its accounts payable to Snappy Tools. So what happened here, Alia?
The cash will reduce by 6,800 and the
Very good.
account payable will increase by 6,800.
Again. One more
The
time.
cash will reduce by 6,800.
Okay, very good, because you make payment.
Yep.
What about your account
And
payable?
the account payable is the right side, right? So it's gonna be it's gonna reduce
Why you say it's reduced?
because we have made payment.
We have made payment because account payable make the payment.
I
We don't.
see.
When you say we are referring to Overnight, the company. But in this case, accounts payable make payment, so the account payable now reduces.
Okay.
Right? Initially, it owes you, for example, 10,000, but now because they made payment 6,008, now reduced by 6,008.
Right.
Right?
Understood.
So what happened is that, all right, you increase your cash because you receive from your accounts payable, but your accounts payable reduces. So now you see that there's an increase in your asset, but there's a decrease in your accounts payable. Right? So, sorry. My fault. Excuse me. Please, all right, stop. Okay. Overnight made a partial payment. So you make payment. So that's why your cash decreases. Make payment to whom? You make payment to your accounts payable. So that's why accounts payable reduces as well. What did I say just now? Alia, sorry. Are you confused, Alia?
Yeah, both of them, I guess, reducing. The cash also reducing, the account payable also reducing.
Yes, very good. Alia, are you okay? I'm sorry. It was my fault.
Yes.
When you make payment, your cash reduces, but accounts payable also reduces because now you have reduced your accounts, you have reduced your liability. Is that okay? Right.
Yep.
So for both sides, in this case, reduce, so it's okay lah. Right. So you have a total of 117 on both sides. And finally, then we have here, what we have here, Overnight recorded auto repair services provided for the last week. So in this case, all right, what happened is that you provide services. So in this case, remember, it's a garage, provide services, right? Overnight auto service. So it provides services to automobile. Yeah. So now you recorded auto repair service provided for the last week. So what happened here is that this is what we call your revenue, right? So when you provide services, means that you, just like you make sales, right? But in this case, you don't sell goods, but you sell your services. So when you sell services, and in this case, the service is 2,200 received in cash, so definitely your cash increases. So your cash will be increased, but you also increase your retained earnings. All right. So why is a retained earnings? So later I will talk about this retained earnings. So normally retained earnings here is that your revenue and your expenses, right? So if you have a revenue of 2,200, so this revenue increase your honest equity, right? So that's why you will have a credit balance, right? It's a revenue, so that's why you put in here, you put in as a retained earnings first. Yeah, we are not going very detailed. We are going to recognize this revenue under retained earnings. All right, so this revenue increases your honest equity. Yeah, all right, so because of that, you have increasing cash and also increase your retained earnings by 2,200, so your balance will still be the same. Right, and then we have another transaction. We make payment for your operating expenses. Right? How you pay? You pay by cash. So what happened here? Hakimi. Hakim?
Yeah, I'm sorry, just I click on the mute. So this transaction, 1,400 will be deducted from your cash. And instead it go to the, and also the, I guess the, from the expenses from the capital stock, also it increased by 1,400.
Why do you
Because-
say that 1,400 should be from the capital stock? Why is a capital stock? Capital stock is investment by the owners. That's all.
Okay. For operation, in this case, operation is also part of the asset section, isn't it?
No.
If it's a asset section, then the operation cost will be added a new account 1,400, and the cash will be deducted by 1,400. In this case, the equation will be the same.
So it means that you are going to reduce your cash and
By
then
1,400.
1,400, and then you reduce another expenses, is it?
Yeah, and added to the expenses 1,400.
Under asset or what? Under asset?
Expenses should be again, yes, it's
Asset? How does that expenses is the benefit to you?
the
What
expense
asset is your resources?
assets. Actually, it should come under the which section? You have
Never mind, I tell you. Before you get more confused.
okay.
Okay, definitely this one, it means that when you make payment for your expenses. All right, in the earlier example, we have services revenue. We have that increase your retained earnings. You see that? So revenue increase your retained earnings. So whenever you have revenue, your owner's equity will increase. Because why? Owner's equity is made up of your capital stock and your retained earnings. So when you have a revenue, you have increased your retained earnings. But when you have expenses, anyone can guess?
Yes, it will be also from the return from the
revenue
profit
expenses
deduction.
Reduce your retained earnings.
Your return earnings, because the return earnings are the balance of the profit and loss statement, I guess.
Yeah.
So if it is the amount of profit and loss statement, so it should be deducted from the retained earnings.
Yes. All right. So what retained earnings is actually from your profit and loss account. So for your
this much is
you have revenue and expenses. So you have a revenue, just now you have 2,200 minus your expenses 800, in this case 1,004, right? So that's why now you have a balance of 800. So retained earnings at this point, all right, you can see that retained earnings is your summary of your profit and loss statement.
profit and loss statement.
Yeah, but you can say that whenever you have a revenue, you increase your retained earnings, but whenever you have expenses, you're going to reduce your retained earnings. Is that clear? Okay.
Yes.
All right, so this one is just to show you what are the movement involved. All right, so for example, when you first have cash investment, so it will increase your cash, and then you have increase your capital stock. And then the next one, when you purchase your land, 52,000, your cash reduces. Next one is that you have purchased a building of 36,000. You pay out cash 6,000, so cash reduces. You see the minus sign here. So it means that there is a reduction, right? So there's a decrease in your cash, but also 36,000 here is also created a note payable of 30,000. So you have on this side 36 minus 6, you have the 30,000, and this side you have 30,000. So you see that for every transaction, debit and credit means that on the right side and the left side must be the same, right? So if you look at here, on the, for example here, right here you have the left side, asset is 80,000, on the right side also 80,000. But the second one, you see minus 52,000. So you have plus 52 and then you have minus 52. So it's zero rise, right? And on the right side, there's no transaction involved. Why? Because here is zero. So now you have the debit side is zero and the other side is also zero. All right, but this one, all right, you see that there's a plus 36,000 and minus 6,000. So plus 36 minus 6 jadi 30,000. So you have the left side is 30,000 and the right side you created a note payable of 30,000. So you see that for every transaction, left side must be the same as the right side. Okay. Here you have positive 13.8 on the right side, 13.8 also. Right. So this one minus 1.8 plus 1.8. So it's set off each other, zero rise. So here is also no transaction on the credit side. Right. But this one debit side on the asset, then you have accounts payable on the credit side. Okay. All right. So what happened is that, right, if looking at this, all right, you see that cash, initially you have 80,000 cash, and with all the transaction, you have a balance of 60,600. So this cash transaction here, later you will see that this will be shown in your statement of your cash flow. Remember your third statement, statement of cash flow. So all this related to cash movement will be shown in your cash flow. Whatever is your retained earnings here is your revenue and expenses. Remember just now, revenue of 2,200 and expense of 1,400. So all these transactions later, you'll see that will be shown in the income statement, or we call it as a profit and loss account, or what is the other one? Income statement. Yeah. All right. And the other here is asset. All right. Here, asset, liability, and non-liability, of course, in your financial position. All right. So this is what I say, that says revenue. If you have your income statement, right, you are going to put your revenue at 2,200 and then operating expenses in the form of wages and utilities, total of 1,004. Then you have revenue minus expenses, you have income of 800. All right. Investment, buy, and payment to the owners are not included in the income statement. So what it says is that, for example, later when the company make payment to the shareholders in the form of dividend, all right, it will not be shown in the income statement. All right, the payment of dividend will be shown later in when you have your statement of retained earnings. Yeah. All right, this is an example of a cash flow where it shows you the cash received. So anything that is received will be in the positive. Anything which is made for payment is a negative. All right. So cash flow later we'll see that there are three types of activities. We have the operating activities, you have investing activities, and financing activities that involve cash. All right. So for here, the operating only involve the revenue and expenses. Yeah. Revenue and expenses, and cash flow from investment, all right, is the purchase and selling of asset. So that's why the name is investing. When you buy asset, normally is for long term, right? So that's why it's known as your investment. So you purchase land, you purchase your building, you purchase tools, and then you also have disposal of your tools. Yeah, you sell your tools. So that will also part of the investment activities, because the sale of tools generate cash of 600, right? And then finally, you have the financing activities, include cash effect, which regard to your owners and your creditors. Any cash received from the investors, all right, it will be under financing. Why is it financing? It means that these are the owners and the creditors are the one who finance the company. Right? So for example, remember just now from zero, right? From zero, the company have nothing, then the owner put in money 80,000. So that using that 80,000, the company buy land, for example. Using that, the balance, they buy another asset. All right. And then if they're not enough, they buy things. And then if not enough, they borrow from creditors. That's your notes payable and in your accounts payable. So you see that, all right, whatever asset that you have will always be financed either by the capital stock or by the liabilities, right? By your payables. Right, so here it shows the asset, the accounting equation, and then date of beginning and what happened in between. Financial statement is where you see that from here is your cash flow. Your cash flow will show you the opening balance, all right, of your cash. You don't have anything from the very beginning. Then only you see the investment, the 80,000. So at the end, you have a cash of 16,006, and this amount is represented in your financial position. You have a balance of cash of 16,600. All right, your statement, income statement here, right? The head shows in the form of retained earnings in the financial position. All right, so these are the three statements. One is your cash flow, here is your income statement, and here is your balance sheet or statement of your financial position. Right, so these are the three. All right, so remember that your financial statement is just one source of financial accounting information, right? So you may have other sources other than this statement of cash flow, balance sheet, and income statement that you can use to make your decision making. All right, other information that you need before you make a decision is your non-financial disclosure, all right, management interpretation, the industry, how it works, and the economy, the polity, all these things we put together lah. But it means that financial accounting is one of the sources of information to help you to make your decision making, right? And then I mentioned about your business organization. You can have a sole proprietorship where you only have one owner. All right, so sole proprietorship in Malaysia, whenever you see company ABC Enterprise, all right, in Malaysia, that is a sole proprietorship. It means that you only have one owner. All right, so that person is actually the one that invests into the business. So normally we see that, for example, small companies, very short, very small enterprises, right? Because it's very risky because there's no limited liability, yeah. And we can also have a partnership. For example, A and B become a partner, all right, they come up with a partnership. But talking about corporation, people or it could be company put money into the companies and become investor, all right, or the shareholders of the company, right? And then
Sorry.
yes,
How much will be the maximum numbers in the partnership? Because there are 3 people.
in Malaysia,
increase it to 5, 10.
2 to 20. All right.
Okay. Okay, thank you.
But now in Malaysia, we have 2 types of partnership, but I do not want to go in detail, yeah. But I just want to mention here that in Malaysia, we have 2 types of partnership. One is what we call traditional partnership, all right? And the other one is what we call limited liability partnership. All right, the limited liability partnership is the new types of partnership where the partners are limited by the amount of investment in the partnership, right? And the method means that in terms of taxation, in terms of the formation of the company is different between the traditional partnership and the limited liability partnership. Okay. So this is, now we finish again, 10 minutes again. All right, we have this sole proprietorship, you only show the owner's equity. All right, partnership, you have to show both partners investment into the company, but corporation, we have a capital stock and the retained earnings. All right, financial statement. All right, you want to look into the liquidity and profitability. Liquidity, you want to look at the cash availability in the company. All right, you want to see whether the company is able to pay up for their liabilities in the short term. All right, so it's very important to look at the liquidity, how much liquid, how much cash company has, yeah. And profitability, you want to see how much profitable is the company. All right, is it good enough, for example? And whenever we want to make a decision, you must have some kind of comparison. You want to compare with what? You want to compare with the previous year's performance, or you want to compare with company A or company B, company C, or you want to compare with the industry. All right, so you must have some kind of a benchmark in order for you to make a comparison on the performance of one company to another. All right, and remember you mentioned about notes to the accounts, all right, that will provide information, more information about the accounts, yeah. For example, just now when we talk about account receivable, maybe they will provide you information about the bad debts or about the policy regard to the credit limit given to your receivable, all right, or how much is your accounts payable, amount due within 1 year or amount due more than 1 year. So all this information will provide more information, all right, to the users. Right, creditors are more likely to extend credit if financial statements show a strong statement of financial position. All right, relatively little debt and large amount of liquid asset. All right, so creditors would like to see that your liquidity. All right, why is a window dressing occurs when management takes measure to make the company appear looks good in the accounts, but actually it's not. Right, so it's the wrong way of doing things. Window dressing. But some company do that, yeah. So it's very dangerous. All right, so it means that you want to show that, oh, company is doing okay, but actually it's not. How do you make that? Because you window dressing, you change the figures. For example, you make it as if the company is doing well. So all these things is what make issues. For example, recently we have the thermodynamic issues, right? Because they have it shows that they have a lot of asset, for example, right? But actually there are a lot of asset were impaired. Yeah, so all this make wrong presentation of the company's performance. Okay, so that ends our chapter 2. I'll see you again, inshallah, in the next. I give you a break of 5 minutes only. I'll meet you again 9:30 in the new Zoom. Is that okay?
Yes, doctor.
All right.
Sorry, doctor. Again, what time we're gonna meet up again?
9:30. Is that enough, or you want 10 minutes break?
10 minutes possible, so we can do Isha prayer.
Okay.
Yeah. So after that, are we going to take a new chapter, or we're gonna do some exercise?
Let me check first if I have any tutorial question. Okay.
Yeah, I think we do some exercises. At least we get more ideas on.
Yes, boss. Okay.
Yeah.
All right. See you, inshallah.
Yeah, see you, inshallah. Thank you so much, Prof.